Your portfolio is bleeding red. Every single stock. Down, down, down. You check your phone, immediately regret it, put it face down on the table, pick it back up 30 seconds later. Still red. The news is screaming about crashes, recessions, and total economic collapse. And you're sitting there wondering whether to sell everything, buy more, or just throw your phone into the ocean. Sound familiar? Because in April 2025, that was the reality for millions of American investors. After President Trump's so-called Liberation Day tariff announcement, the S&P 500 shed over $5 trillion in market value in just 2 days, according to S&P Dow Jones indices. 2 days. The Nasdaq officially entered bear market territory. People were panicking, chaos everywhere. And here's the thing, some people lost a fortune, and some people quietly made one. So which side do you want to be on? Because in this video, we're going to break down exactly why stock markets crash, whether you should actually be worried, and most importantly, how some investors come out of a crash richer than they went in. This is the stuff most people learn the hard way. You're going to learn it right now. I'm Jack. If you'd rather learn how to handle a market crash than just scream into a pillow about it, hit like and subscribe. Section 1. Why do stock markets crash? Okay, let's start at the beginning. Why do crashes even happen? Is it Wall Street bankers in suits doing evil things? Sometimes, honestly, kind of. But mostly it comes down to 3 causes: bubbles, bad economic conditions, and what the finance world dramatically calls black swan events. Let's go through each one. Cause number 1, bubbles bursting. A bubble is what happens when stock prices get completely divorced from reality, driven by hype, not actual business performance. Investors pile in, prices soar, everyone's making money, and then someone looks around and goes, "Wait, does this company actually make anything?" And the whole thing collapses. The most famous example, the dot-com bubble. In the late 1990s, investors threw money at anything with .com in the name, even companies with 0 profits and 0 real business models. The Nasdaq, the tech-heavy index, surged over 800% at its peak. Then reality hit. When investors realized most of these companies weren't making a dime, they sold everything at once, and the Nasdaq crashed nearly 80%. It then took 15 years to get back to where it was before the bubble. 15 years! That's enough time to raise a child from birth to high school. Cause number 2, bad economic conditions and policy. When inflation runs hot, everyday Americans feel it. Food costs more, rent costs more, everything costs more. People spend less. Businesses earn less. Investors get nervous and sell stocks. Throw in a potential recession, and that nervousness turns into full-on panic. Central bank policy plays a huge role here too. When the Federal Reserve raises interest rates to fight inflation, borrowing gets expensive for businesses, which slows growth, which spooks investors. And every time the Fed chair steps up to that podium, you can practically hear 1 million investors collectively holding their breath. Because number 3, black swan events. These are the curveballs nobody sees coming. Pandemics, wars, geopolitical shocks, major policy surprises. The 2020 COVID-19 crash? Nobody had global pandemic on their 2020 bingo card. Markets fell over 34% in just 33 days, according to data from Apprise Wealth Management. One of the fastest bear markets in history. More recently, those same Trump tariffs we mentioned in the intro. The Liberation Day announcement in April 2025 caused the single largest global market sell-off since COVID, according to Wikipedia's market analysis. Nobody fully predicted the scope of it. That's what a black swan looks like. Section 2. Is this normal? Should you actually be worried? Here's the part where most financial media loses the plot completely. They want you scared, because scared people watch more news. But the truth? Market downturns are completely historically, boringly normal. According to data compiled by Covenant Wealth Advisors using S&P 500 figures, since 1980, declines of 5% or more have happened an average of 4.6 times per year. That's not a crisis. That's just Tuesday. So let's talk about the different flavors of market pain, because not all drops are created equal. At the mildest end, you've got pullbacks, drops of 5 to 10%, which happen multiple times a year and are basically just the market's way of catching its breath. Then come corrections, which are drops of 10 to 20%. These happen roughly every 1 to 2 years on average, and in 2022 alone, there were 4 of them. 4. In 2025, the S&P 500 entered correction territory when it dropped 10.1% from its February peak by March 13th, per S&P Global data. Then you've got bear markets, drops of 20 to 40%, which tend to show up every 5 to 6 years, usually tied to economic slowdowns. And finally, at the extreme end, full-blown crashes of 40% or more, which happen maybe once every 10 to 20 years. Those are the ones that make the history books. And here's what the history books show every single time. The market bounces back. According to data from Covenant Wealth Advisors, $1 invested in the S&P 500 at the start of 1926 would have grown to approximately $20,000 by early 2026, assuming dividends were reinvested. Through the Great Depression, through World War II, through the dot-com crash, through 2008, through COVID, through tariff chaos, still $20,000. Now, that's not a guarantee for the future. No one can promise you that. But that track record is hard to argue with. And look at the individual recoveries. Black Monday in 1987, the Dow crashed 22.6% in a single day, which sounds absolutely terrifying, and it was, but the market recovered in under 2 years. The 2008 financial crisis saw the S&P 500 fall nearly 57% from peak to trough, and it still came all the way back in about 4 years. The 2020 COVID crash dropped 34% in 33 days, and then fully recovered in roughly 4 months. And the 2025 tariff crash? The S&P 500 surged over 9% in a single day after a tariff pause was announced, per YCharts data, and had fully recovered to new all-time highs by June 27, 2025. So when should you actually be worried? When the entire economic engine breaks down, when businesses stop operating en masse, banks fail, and people can't access their money. That's a different animal entirely, and it's historically very rare, especially in the United States. If people are still shopping, working, and complaining about prices on social media, that's a recession, not an economic apocalypse. Section 3. How to survive and actually profit from a crash. Alright, this is the section you actually came here for. Because crashes aren't just something to survive. For prepared investors, they're one of the greatest wealth-building opportunities that exist. Warren Buffett said it best, "Be greedy when others are fearful." So let's break down the mistakes that kill most portfolios during a crash, and what to do instead. Mistake number 1, panic selling. When everything is red, every instinct you have screams, "Get out." But here's the thing, you haven't actually lost money until you sell. A stock that's down 30% on paper can still fully recover. The moment you sell, though, that loss is locked in forever. During the COVID crash, anyone who panic sold in March 2020 missed one of the fastest recoveries ever recorded. And after Liberation Day in April 2025, investors who bailed missed a historic single-day rebound just days later. Stay calm, stay informed, and don't sell unless the company itself is fundamentally broken, not just temporarily beaten up. Mistake number 2, trying to time the bottom. Nobody, not even the best Wall Street professionals, can consistently nail the exact bottom of a crash. You'll either buy too early and watch it fall further, or wait so long you miss the recovery entirely. The smarter move is dollar cost averaging and investing a fixed amount on a regular schedule no matter what the market is doing. When prices are low, you automatically buy more shares. When they're high, you buy fewer. No crystal ball required. Mistake number 3. Buying trash. Just because it's cheap, a stock being down 60% doesn't make it a bargain. Some companies deserve to be worth less, or nothing at all. Most dot-com era companies that crashed never came back. Buying a bad business at a discount is still buying a bad business. Instead, focus on strong, profitable companies with low debt and solid earnings. The ones that got dragged down simply because everyone's panicking, not because they're actually in trouble. Take Amazon during the 2008 crisis. It dropped from $90 to under $40 a share. A $1,000 investment at the bottom would have grown to over $75,000 by 2021. That's the opportunity a crash creates, but only if you buy the right companies. Mistake number 4. Not diversifying. Some sectors get obliterated in a downturn while others barely flinch. During the 2025 tariff crash, tech and trade-heavy stocks took a beating, while utilities and healthcare held up far better. Spreading your money across different sectors means no single crash can wipe you out entirely. And if picking individual stocks feels overwhelming, index funds and ETFs do this automatically. Simple, effective, and historically very hard to beat. Mistake number 5. Following the herd. When panic spreads, people sell because everyone else is selling. When FOMO kicks in, people buy because everyone else is buying. Both are how ordinary investors lose money. What actually works is understanding what you own and why you own it. If you know why a company is a strong long-term bet, a 20% drop won't rattle you. You'll see it as a sale. And if you're not sure, that's what financial advisors are for. Here's the bottom line. Stock market crashes feel catastrophic when you're in them. The numbers are terrifying, the news is relentless, and your stomach tells you to do something, anything, to make it stop. But history, backed by nearly a century of data, shows the same pattern over and over again. Markets fall, they recover, and they eventually hit new highs. The investors who build real wealth aren't the ones who predicted every crash. They're the ones who stayed calm, kept investing in quality companies, and let time do the heavy lifting. The crash you're worried about right now, it might just be the opportunity you've been waiting for. Don't fear the next crash. Be ready for it. If you want to actually understand your money instead of just hoping for the best, hit like and subscribe right now. We break down investing, markets, and personal finance in a way that actually makes sense. We'll see you in the next one.